Good morning, everyone. I'm here with Gustavo. How are you, Gus?
Great, and you, how are you doing?
All good, all good.
Good to be back here.
Thank you. Thank you for being here. Who's our guest today, Gus?
Great. So our guest today is Julio Vasconcellos. Julio is now the founding partner of Atlantico VC, which one of Brazil's best Series A investors, going about in Latam. He'll speak up more about that now. But Julio's got an amazing story going through Facebook, big tech, then founding Peixe Urbano, then becoming partner, entrepreneur in residence in Benchmark Capital, then coming back to Brazil and becoming a prolific investor in Canary and Atlantico, and also at Graph Ventures. Julius, thank you for coming.
Thank you. Thank you for having me.
Thank you, Julio. So we usually like to start with more like the personal story of our guests. So tell us a bit about your background. Where did you grow up? Where did you go to school? What did you do after school?
Yeah, so I think that the main thing to note about my background is that my father was a diplomat for the Brazilian Foreign Service. So that question, where did you grow up, is a bit of a longer answer than most probably, because I basically grew up moving every 3 years of my life. So I kind of perfected the art of being the new kid in school, and I was born in Canada, lived in Canada, Peru, Brazil, obviously a bunch of times, always in Brasilia, the capital, in the U.S., in Canada again, and eventually kind of graduated high school in Brazil and went to college in the U.S., in Philadelphia at the University of Pennsylvania.
Amazing. How different were each of those countries to grow into?
I think that when you're a little kid and you're growing up, honestly, your life is not that different, right? Kind of you're at home, you play with your friends, and can you go to school? So I think that my experience, I think, sort of throughout was actually pretty consistent, even though the countries are obviously quite different, right? Just to give you a sense, I think when I lived in Peru, it was sort of when the terrorist attacks in the 80s were happening, right? Especially against foreigners, right? So it was like a very, very different time than you had many years later. And then obviously living in the suburbs outside of Washington D.C. is probably the complete opposite of that. But day to day, I think your day to day, especially as a 10-year-old or 12-year-old or 6-year-old, it's kind of the same, right? You see your friends, you see your parents. It all feels pretty much the same. And I felt like I had an opportunity to grow up at each one of those places, sort of at the right time in my life. In other words, I think going to high school or finishing high school in Brazil is probably the best place, right? Because you have a lot more freedom. You can go out, you can do a lot of more fun things than, for example, I think in the U.S. where the legal drinking age is 21. You're living kind of in a boring suburb and you don't have anything else to do, right?
But you have deeper roots in Brazil and the US, right?
Yeah, my whole
Or not?
family is Brazilian. Both my parents for a long time, and that's where I would always come back to for all the holidays. That's where my family lives. So it was almost like we were always living abroad for extended periods of time, but we would always come back home. That was always Brazil.
Yeah, it's funny that you mentioned this. Sorry, because I was actually having like a conversation with my wife the other day because we have a young daughter that's almost 3, and we were talking about this about schools and all this kind of stuff and moving cities or moving countries and stuff like that. And we were like, no, no, no. If she turns like 8, we cannot move countries anymore or cities because she would lose all her friends and all that kind of stuff, and we would feel bad about it. But it's good to see like firsthand other stories where you jump from city to city or country to country every 3 years, and you still did okay, Julio. So yeah.
Yeah, I think that when you look at people that grow up like that, I think that it's very binary. Like either they kind of end up really messed up because they kind of rebel against their parents and I think kind of go in a darker direction, or I think that they end up being quite resilient and dynamic as far as being, I think maybe seeing sort of the positive elements of change and sort of embracing that, I think, as you're growing up and eventually later on in life. But I do want to say people always said, oh, that must have been a lot of fun. But I think it was quite the opposite. I think as you're growing up, I quite hated moving around every time, right? Because like your daughter, no one likes to leave their friends and their girlfriends behind and have to kind of go to a new school. So the actual process is very tough, but obviously going through that process and I don't know, emerging on the other side makes you stronger. It makes you better going through it in future times.
Do you think it shaped you in more like a liquid personality? You adapt faster?
I think that I usually see the positive side of change, right? I sort of always take a positive spin of like, oh, we have to move or we have to change something. I feel like I try to be fairly optimistic about what can come out of changing circumstances. I don't know if it necessarily makes me more adaptable, but it definitely gives me like much. I think I approach it much more with a growth mindset that something positive is going to come out of it, rather than resisting change or even being afraid of it. I think being afraid of it obviously is a natural emotion, but I think sort of taking that fear or that anxiety or that uncertainty and sort of channeling it for good and for growth is, I think maybe that's where I emerge stronger from the experience.
I can imagine that shaping up your trajectory as founder, then investor, and so forth.
Yeah.
Okay, so let's start then. So you did business. You did business in Wharton. Then you went to New York for the to work in Monitor Group, and then you went to the Bay Area in 2005, right?
Exactly.
And how was the Bay Area at the time? It was a
Yes,
post bubble Bay Area, things coming up.
exactly. Let me give you a little bit of like historical context, right? Because I had always liked technology from like an investment standpoint, right? And I think it was very much like when I was in high school, I used to invest in the stock market because I felt like I wanted to be like a stock trader at some point. And when I was investing in the stock market, it was during the dot com boom. So it was very easy for you to make money, right? You just throw darts at the dartboard and everyone would make money. And I invested a lot in tech stocks that grew a lot. And I ended up making a lot of money as a 14-year-old investing, 14, 15-year-old investing in the stock market. And I always had this like romantic view of, the dot com and that growth and sort of that dynamic period. And I lived through the dot com bust during college, right? So I always felt like, look, this is an interesting opportunity. And then it kind of ended, right? So when I graduated from college, which was in 2002, the internet era, the dot com boom and bust was sort of a thing of the past, was sort of, especially, in New York, it was like, oh, that was cute. Everyone thought that was going to work, but obviously didn't work. Let's go back to Wall Street. Let's go back to where the real money is. But I always had that in the back of my mind. Okay, this is a really cool thing. How can I kind of get into that world? And as you mentioned, I went to work as a management consultant in New York for a few years after I graduated from college. And then I wanted to start something. I wanted to be an entrepreneur, and I wanted to go into tech, and I didn't know how to do it. And I felt like I wanted to do it in tech. And living in New York and trying to go into technology in 2003, 2004, there was literally nothing to do and no one that you could meet that was in technology. And what I knew was that there was still some of that going on, and that was still going on in Silicon Valley. And I felt like kind of going there is what I needed to do to figure out how do I insert myself in this world. And I did, I think, what at the time seemed like the most obvious thing for a management consultant in New York without any experience in technology, which was let me go get my MBA in the West Coast, right? So I applied to a business school to go to Stanford. It was sort of the only school I applied because I kind of wanted to go out there, and then ended up getting in, right? And this is 2004. Again, as I mentioned, nothing really happening of note in technology, right? 2004, if I remember correctly, was the year that Facebook was started. So it was still a company in a dorm room at Harvard. I think Google, which was the highest flying company at the time, was still kind of, oh, it's just that little search engine out on the West Coast. I think it went public in '04 or '05, if I remember correctly. So it was sort of finally, I think, coming to light in the world stage. When you thought about sort of the East Coast world that I inhabited. So I moved out west to 2005. And I think it was really a choice of kind of being at the right place at the right time, right? Because if you think about 2005 is really maybe the first year or the inflection point that we've probably been living through now for the last, 15 to 18 years when you think about kind of the tech boom, irrespective of some of the booms and busts that we've had in the past. And the fact that I was at Stanford at the time and I was in my class, my class of almost 400 students, probably one of 30 or 40 students that wanted to work in tech and be, in technology in some way, meant that we ended up having a ton of access, right? Because the next 2 years that I was out there, all the technology companies were coming to Stanford wanting to meet students. And there were a few of us that sort of genuinely kind of loved, innovation, loved entrepreneurship. I wanted to be there before I think it became kind of the cool thing to do. And that opened up a lot of doors for us.
And the eat segments of the time was it social media?
Social media, definitely when I graduated, which was in '07, it was social media, right? I think sort of the hot company to go work at the time was Facebook. But even then, I mean, there weren't that many people in my class that, for example, wanted to go work at Facebook. I think there were maybe like two people out of the 400, maybe three that went to work at Facebook. The year before, also maybe another two people. Facebook was probably between 100 and 200 people, so also wasn't a huge company. But definitely it was kind of the hot company at the time that a lot of folks were looking at. And I think probably the next one was probably Google, which obviously was already a big company with thousands of employees, but still kind of felt startup-y, especially for I think business school students that are probably always a few years behind what like real innovation is like.
Fantastic. And how did you land the Facebook job? I mean, you it was one of those eat jobs, right? So,
Yeah, so I
Jaime Julio was the first employee of Facebook in Brazil, country manager in 2010. He came here when Facebook was nothing, right?
Yeah, so I mean, to give you a little bit of context, after I graduated, I went to work at a social networking startup. I was the first employee at that startup that the founder had sort of built that first version of the website, and he wanted to hire someone to help with sort of product management and growth and sales. I mean, basically everything that was not software engineering. And I joined that company. It was a company called Experience Project. I didn't go work at Facebook because I felt like, oh, Facebook's already a big company. It's already had, I don't know, 100 to 200 employees. I wanted to feel like I was more at a startup, like on the ground stage. And that's why I chose to go to that company. And I had started working in marketing and product already for a few years. I think what back then was called, viral marketing or sort of viral product management, things like that, which I think nowadays probably people call growth, right? And I was one of the few people, really in Silicon Valley that was kind of really specializing in that at the time. There were probably, I don't know, 100 of us that were people that were working in growth at Silicon Valley at the time. And really, I think where a lot of the best people in that space were at was at Facebook, right? Facebook famously created probably what was the first growth team of any technology company. Again, like that wasn't even what was called, right? Like eventually, Facebook sort of created that name and said, "So this is growth," or at least popularized that name. And it was a team that was run by Chamath Palihapitiya, who at the time was sort of Mark Zuckerberg's right hand at Facebook and had about 20 people or so on his team. And one of those people on his team was a Spanish guy, Javier Olivan, who's one of my really close friends back from business school. And Javi had been hired to run international. And I think under Javi, there were, I don't know, two, three, I don't know, maybe like four people, let's say, that were looking at international. Because to give you some context, when I joined Facebook, which was sort of, I don't know, we started, talking about it and working together, I think end of 2009, beginning 2010. That was sort of roughly when Facebook was starting to really expand and step on the gas pedal as far as international growth was. The company was probably, I don't know, 500 to 700 employees, right? Everyone still fit in a single office. That was sort of the scale, and they wanted people to help with international. And who was there that had any experience internationally and worked in growth? There were, I don't know, a dozen of us around, and that's why Javi and Chamath and the rest of the team started kind of calling on me for a while and said, "Hey, come work with us. Come work with us. We need someone to help us with Latin America, specifically with Brazil, where at the time, Orkut, which was a Google social network, was sort of a big, strong incumbent that was a big competitor." And I said, "Look, I don't want to work at Facebook. It's a big company. It's hundreds of people. I really want to start my own thing." And I think sort of the deal that Chamath put on the table was, "Look, why don't you join us on the growth team? You help us grow in Brazil, and sort of at on halftime or on your evenings, you kind of get your startup off the ground. And I'll be your first investor. Javi is going to also be kind of your first investor. We'll help you get this company off the ground, and eventually, when it starts going, if it starts going, the deal is you help us hire someone in your place, and you go off and run that startup." So that's how I ended up there. It was a very atypical way. It was a very atypical hire, that for me felt like it was a great bridge for me to come back to Brazil, through obviously a company that was well known and respected, which was Facebook at the time, but really a way for me to come back to Brazil and start my own company, which is what I ultimately wanted to do.
So this was Facebook's way of making a Godfather like offer of this is an offer you can refuse.
Yeah, and I think back then the company was sort of very flexible in terms of like kind of making these special deals and these special investments and stuff. So I think maybe it's kind of that flexibility and scrappiness is what I think let Facebook succeed in those early years, and particularly in the growth team, which was a team of 20 people that took Facebook from millions of people using it a month to a billion people using it a month, right? And it was really kind of like, we have this goal, let's get the right people, let's be scrappy, let's be creative, and get this off the ground. And for me, it worked, right? Like if they had said, look, you have to come full time and be fully dedicated to this, I would have said no, which is what I had been saying for the last many months that they had been calling me.
And that's actually the team or the time of the tech history that I believe the growth term was first coined, probably.
Yeah, or at least popularized for sure. Yeah.
So then you have someone who was working in Silicon Valley for 5 years in social media, was buzzing at the time. After Stanford and so forth, then you come to Brazil, and what do you find in Brazil? Because in 2010, Brazilian tech was not exactly booming at the time, right?
Right. I think Brazilian tech in 2010 was sort of very similar to the description of sort of US tech that I gave in like 2003 2004, right, when I was kind of thinking about going out west to Silicon Valley. I think you had the boom and bust of the dot com period in Brazil, which I think started later than the US and kind of ended right around the same time. And then you had this nuclear winter of technology that in the case of Brazil also lasted a lot longer. So it lasted from 2001 until kind of really like 2009, probably 2010. I think that one of the big moments of that period was when Buscapé, the price comparison engine, which had been a company had been started during the .com and survived all that period, was bought by Naspers for several hundreds of millions of dollars, and sort of like it kind of put Brazil and technology back on the map. I think people started thinking about it, but still very few new companies had been started at that period. And that was exactly what attracted me to move back to Brazil and at that time, right? As you said, I thought, look, I have 5 years working in tech in Silicon Valley. I think in a time where honestly there weren't that many people, at least definitely not compared to today, doing that. And almost probably enough, like Brazilians that you could count on one hand, right, that were doing that. And I felt like I could take this knowledge and this experience, come back home and use that to start a company in where I felt was very much kind of a greenfield opportunity for entrepreneurs in technology. And that's exactly what I did, right? I came back with Facebook. I had already been thinking about several ideas of companies that I wanted to start. I had decided I wanted to do something kind of in the local services space. I felt like it was a big unexplored opportunity. And after a few trials and different pilots and different kind of prototypes that me and my co-founder Alex were playing around with, we eventually said, look, this model that sort of Groupon pioneered in the US and has been growing insanely well around the world. Not even around the world, only in the US at that time. In Europe, they only started also in 2010. We should bring that to Brazil because that's a really innovative way of acquiring a lot of consumers that are interested in trying new things in their city and acquiring a lot of small businesses that kind of want to grow. And then once we have both sides of that equation, the consumer and the businesses, we can build a lot of things on top of that. And that's how we started Peixe Urbano. We were, a daily deal site, very much a copy of Groupon with a few kind of adaptations for the local market, but really with a vision to do everything in the local stack. So, we started with the Groupon model. Within a year, we had launched, food delivery, right? Kind of like Seamless and Grubhub and all these other companies. We launched restaurant reservations like OpenTable, The Fork, etc. We launched content like Yelp. So we were really doing everything in local, which we felt were very synergistic. And there was no one doing any of this in Brazil at the time. So we felt like that greenfield opportunity was really unique.
So we interviewed a lot of people coming from the Groupon Mafia here in Brazil. And everybody, of course, mentioned Peixe Urbano. And Peixe Urbano is funny because after Facebook, Peixe Urbano could be the epitome of product market fit. It was very fast, very high demand. But I mean, you were coming from the Silicon Valley to Brazil and Facebook. You probably found a region with scarcity of talent, scarcity of investors, not very tech savvy at the time. So you decided to found a company here. How did that equate in the beginning? I mean, was it very hard to found to start a company? Was it very hard to hire? Who were the people that you were hiring against the people who you had been working with for the last couple of years?
Yeah, I think that back to maybe my background and seeing kind of the positive side of things, I felt like sure there was, limited talent with experience in tech, and there was little sort of infrastructure, be it, financial, human capital, legal, et cetera, to start a company. But also the fact that it was so greenfield and so new was part of the opportunity because there was also no competition, right? I mean, it actually happened that in the daily deal space, that was the one exception that we picked where there was a ton of competition. But in general, starting a technology company at the time meant that sure, it's going to be harder, but if you're able to get it off the ground, you'll be able to, swim freely without any competitors. So we saw very we saw it very positively in that regard, rather than starting a company in the U.S. where any idea you have, there's tons of people doing the same thing with deep financial pockets, access to a lot of human capital as well. So I hired much more based on potential than experience, right? It was people that had sort of the raw skills and raw talent that we felt we could shape and work with, that were kind of going to figure out the way of kind of building a company with, I think, minimal guidance. I think that was a key learning. And the other thing we tried to do was try to bring in some of these people that could teach them, right? So we brought in people in product management and software engineering and product design and marketing from the US, right? We imported these people that had the experience. They didn't have any experience in Brazil, and said, look, these are subject matter, I don't know, not experts, but subject matter experienced people that can teach you the ways of how to do this. And then what we would bring was sort of really great talent that was looking to learn and try to grow. And I think that combination led us to build a really sort of amazing team in those early days.
And just so everybody understands, how big and how fast was Peixe Urbano?
Yeah, it was really fast. Like, just to give you a sense or like an anecdote, anyone that has visited a like corporate building in Brazil or in São Paulo knows that you show up at the reception, and the receptionist will ask you kind of, well, what company are you with? And at the time, I was going to a lot of meetings, so representing Facebook and some representing Peixe Urbano. And when I would go and say, oh, I'm at Facebook, and they'd be like, how do you spell that? Like, what is that? Like, people just hadn't heard of Facebook, right? There were, maybe between 1 and 3 million users in Brazil at the time, like very few. And when I would go and say like, "Hey, I'm with Peixe Urbano," people would be like, "Oh, that's amazing! Like last week I bought this coupon, like whatever," and it was like 100% recall. And we probably had also like 2, 3 million like registered users, right? So we had grown like super fast in those first few months, and we're kind of neck and neck with Facebook. Obviously, Facebook left us way behind, and it was obviously much more mass appeal. But it was curious to see in the beginning that like my company Peixe Urbano was better known by someone on the street than even sort of this giant in Silicon Valley, which was Facebook. But to give you some numbers, we went from me and my co-founder Alex working out of his living room in his apartment in Rio de Janeiro to about a little over 1,200 people in 100 cities across 6 countries and sort of all Latin America in the span of about a year and a half, about a year and a half, 2 years. By the end of the year, we launched in April, like end of March. So at the end of the year, 9 months after we launched, we already had sort of 300 people, just to give you a sense. The company at that point, sort of the year and a half to 2 year mark, at the peak, was doing about $250 million of sales a year. That translated to a little over $100 million of sort of net revenue that we would keep a year, again in like a little under 2 years. So from a geographic context, being present with people on the ground in 100 cities is like really overwhelming. I think having like operations in 6 different countries with different regulations and different ways of doing business is sort of overwhelming. Over 1,000 employees, that kind of level of sort of financial volume and turnover in under 2 years, it gives you a sense of just like the breakneck speed that things were happening, right? And how overwhelming it was to try to just try to do our best to keep this, plane from coming apart, sort of as we built it midair.
I met Julio the first time at a Goldman Sachs hosted a lunch in a restaurant in São Paulo. Yeah, Goldman was probably raising a pre-IPO round of Peixe Urbano at the time. I mean, it was as hot as it could be.
Yeah, I mean, I think that so from a fundraising standpoint, also we raised like our seed round, and then a Series A, a B, a C. I mean, Series C was like supposed to be our like pre-IPO round, as you mentioned. Um, and yeah, I think that's maybe when we started, talking to some investment banks and doing some of these events. And just to give you a sense, we didn't raise. I mean, in today's dollars, it wasn't that much money, right? We raised like in total just a little over $100 million across all those rounds. Being that kind of that last round was like an $80 million round. So before we got to that pre-IPO round, we had only raised, I don't know, a little under $30 million in total to get to that. And up to the Series C, we actually hadn't spent any of the money we raised, because the company from a profitability standpoint was actually quite healthy, and also from a cash flow standpoint was actually sort of cash flow break even or cash flow positive, depending on how it was, because the cash cycle like sort of played in our favor. So only until we raised that big growth round, and then eventually a few months after that, when the market really collapsed, that we even had the need to raise outside capital, which is very curious.
And then the market collapsed.
Yeah, I think ultimately, long story short, this daily deal model, which was still the bulk of our revenues, right? We had launched all these other things, the food delivery, reservations, etc. The sort of the coupon daily deal model ultimately proved to be unsustainable. I think that and I think many people might have different theories for why that is, and I don't want to get super deep into it. But I think ultimately, there was a bit of a race to the bottom because there were such low barriers to entry in the business. We had over 1,000 competitors just in Brazil. So it meant that the quality of the offers and the quality of the service kind of went really low, as different sort of fly by night players and operations try to just extract as much cash out of the business as possible. I think that ultimately led to consumers being burned by the model and churning. It also meant that small businesses were were burned by the model and churned. And I think that sort of the category as a whole became sort of poorly seen by both consumers and businesses, and developed, I think, a lot of bad habits in terms of the types of offers, the types of businesses that were allowed on the platform. And I think that just led to this spiraling kind of death spiral of churn, ultimately, both on the consumer and the business side. Price competition between the big players being really us and Groupon, which meant sort of margins went way down. Sort of it's just this death spiral of declining top line sales, declining profit margins, increasing acquisition costs in the face of, I think, sort of this negative publicity that meant that I don't know, I don't remember what the numbers were, but probably our top line sales probably were cut by half or something like that in the matter of, I want to say, 6 months. Our margins were cut by half, which means sort of our net revenue was cut by a quarter, right? If you think about half of a half, and costs started kind of ballooning, right, in parallel. So a business that was basically profitable or break even went to, because of that scale as well, went to burning a lot of cash very fast. And yeah, and I think we were sort of facing imminent death if we hadn't acted fairly quick to turn around things. We had the, I don't know if it's good fortune the right word, but we had the advantage of seeing Groupon go through the exact same boom and bust in the U.S. probably about 6 or 9 months ahead of us. Just to give you some context, Groupon was on the cover of, I think it was Fortune magazine, and it says something. Groupon is the fastest growing company ever. And to give you some numbers there, the company went from founding to going public in, I think, a little under 4 years. I think it was like 3.5 years. And it reached a peak market cap of about $30 billion. Just to give you a sense of how fast and massive that scale was. About a year later, it was worth a billion or two, right? Had lost 95% of its market cap. So we had seen that happen, and as soon as our numbers started going sideways, we saw, hey, this thing is not gonna end well, and therefore we were able to react quite quickly, right? Just to give you a sense again of some numbers, in the matter of 9 months, I would say that the turnaround phase of the business lasted. We cut 85% of our costs. We cut two-thirds of our headcount of our people. We sold off all the businesses outside of Brazil. We sold or closed all these adjacent businesses from the daily deal business and kind of just focused on that one, I would say that one third of the business that was sort of still really profitable and sustainable. So shrunk the business, but kind of got it back to profitability after sort of a very painful and very sudden and abrupt turnaround phase.
So in all this conversation, of course, we have a lot of reference to the current environment. When you're speaking about New York at the time, and that tech was a cute thing. Now let's go back to what makes money. You can relate that to the crypto environment right now. When you get to Groupon and the Forbes magazine, and then going public, you can relate that to several of the startups, and of course to the FTX saga and so forth. But in this story, you definitely have a very good relationship with the VC winter and the layoff environment and everybody cutting back costs, extending runway. What would you say were your, I don't know, top three key decisions that made this a good story and not a nightmare? Uh, and at what point in time did you start talking about selling the company, which you ended up selling the company to Baidu?
Yeah, I think that probably the key decision was just to cut and cut fast. So I think we react. I mean, we probably started seeing the numbers a little shaky um, at the end of the year. Just to get like calendar year, so it was like I don't know November, December. Um, so I think we were on alert that something was up. But for anyone that's worked in retail in Brazil and in e-commerce, you'll know that after the holiday season, sort of after Christmas season, January is holidays. So usually every year sales go down. And then usually you have the Carnival holiday, which is also about a week that typically falls in February, sometimes in March, but that year it fell in February. So we had these 2 months that were weird months, right? Because it's like there's usually seasonality. So there was also this element of like a fog of understanding of exactly where we were. And then immediately as we emerged from that in March, so we kind of just held firm and said, look, we kind of got to wait out January and February to see how things come back. And we went to March and we saw that things didn't change. And then we cut really fast, right? So if you think about the whole thing, it took us about 4 months to react. Two of those months were months that we just like didn't have any visibility. So I think the fact that we were able to move quite fast was really important and was I think key to the fact that we survived and pretty much everyone else died. Um, everywhere in the world. So that was number one. Was like as soon as you start seeing things are not going well, is just make the hard decisions and kind of move very swiftly to execute them. I think it's number one, it's hard to make the decision. Number two, it's hard to execute it when you think about people that ultimately are your friends and that you've grown accustomed to and you have a good relationship with. I think everyone wants to be optimistic, but sometimes being realistic is the sort of the best course of action. So that would be number one. I think, and number two was just kind of put on hold a little bit of our long term vision of this kind of end all and be all of being this local services hub, right? So at the end of the day, shutting down some of these adjacent businesses and some of the sort of the innovation and new stuff that we were doing, because not that vision didn't make sense or we didn't kind of believe in it in the long term, but I think you have to first survive and first succeed to then be able to kind of build towards the ultimate vision. So I think also being able to let go of that was really critical rather than kind of continue to be hopeful and continue to kind of go after this more grandiose vision for the long term. I think those are probably the two fastest things to do.
No, and fast forwarding in time, now as an investor, you were experiencing the winter VC. Um, how did you see that, and how did you play that with your portfolio companies?
Yeah, so I think what we try to say was look, the market is bad. We don't know how much worse it's going to get, and we don't know how long it's going to last. So kind of hope for the best, but plan for the worst. which means cut your costs, cut your headcount. I think a lot of folks made the same mistake that I did, which was maybe wait a month or two longer, and I think that's natural. And we try to drive some sense of urgency, but also I think respected entrepreneurs' timing, not from making a mistake standpoint, but just having a sense of where things really were. So I think number one, we try to say, hey, do move as fast as you can. I think people like us could have always moved a little faster, but I think again, in hindsight, everything is much clearer. And the other thing that we said a lot was whatever you think you're going to cut as far as headcount and costs, cut at least twice that much. And I think that was again advice that was given to me when I was cutting costs. It was advice that I didn't listen to, and I probably went through, I don't know, two or three big waves of layoffs. And in hindsight, again, I was like, well, I should have just done what they told me to do. And I think again, with the majority of our founders and people and friends that I've counseled, the same thing, right? Everyone thinks that they're cutting a lot, but they always go back and kind of cut a second or a third time. And that obviously not only from a additional burn standpoint, but I think just the impact on culture and morale is much bigger. So I think always just cutting more is hard, and that's the advice that we gave. And I think that it's unless you've gone through it, it's tough to do. I think the other learning we had with Peixe Urbano was that a lot of times a smaller team that is comprised of the best people and that are most motivated can actually produce a lot more than even a larger team. And I don't mean on a proportional basis, I mean on an absolute basis. I think when we were a third of the headcount that we were at their peak, we were probably moving faster in terms of innovation and development than we were when we were three times as many people. And I think that I told all of our founders, look, you'll see that when you cut, you think you can't operate, but actually you'll see that you're actually going to move much faster. And I think that was also kind of a big learning that a lot of folks that went through this up and down of the last couple of years, I think, came away with from the experience. And I think it's hard for you to just accept that advice from someone until you live through it. So I think that this experience of going through it yourself, I think, made a lot of the founders that we have in our portfolio, and I think that we interact with, a lot stronger because of it. I think that they'll be able to make better decisions, and I think make the faster decisions in the future as they encounter, as they invariably will, sort of other challenges up front.
The whole thing, Julia, about making costs, especially laying off people. I mean, it must have like a huge psychological and human component. Because as you said, I mean, that's the advice that you were giving to your founders, because you had gone through it and they hadn't. But even if you look at what big tech has done in the past, I don't know, say a couple of years or 18 months, I mean, the same has happened to them. And these are very experienced people with boards formed by people who have done it and seen it before. And still the Facebooks of the world, Googles and all of the, and many of those guys, they not only did one round of layoffs, but they, in most situations, they had to do two, three, or even more. I think Apple was probably the only one that did just one or none at all. But the rest of the guys, despite their experience, ended up having to do more than one. So there's probably like a huge psychological or human component with that kind of stuff, or of underestimating how much you need to do.
Yeah, and I think underestimating how much people that you have can do, right? I had a good friend of mine who was our COO for a while, and sort of the way he would manage was he would sort of come up with these goals for his team and say like, hey, I don't know, maybe it's customer support, right? Like maybe you're answering, 20 customer support tickets, I don't know, an hour. And he would say, I want you to do 50. They're like, oh, that's impossible, whatever. It's like, and he would just sort of set these very ambitious goals, and ultimately people would get there, right? So a lot of times it was like, oh, it's not possible to do because we've never tried it. And it was a similar thing that we found, right? It's like, oh, we can't do it because today we need like 50 people to do this work. And then you would cut it to 10, and then somehow people would be creative enough and they would figure out a way to, with 10 people, do the work of 50. And time again, in software engineering, in operations, in sales, and customer support, we saw this being possible within our own company. And now we've seen it sort of with portfolio companies. So what I would also tell entrepreneurs is just set these goals that seem impossible, because ultimately I think most of the time people will be able to achieve them. And I think that that's a little bit of where you're kind of jumping into, like, you're jumping out of a plane, right, without knowing whether you have a parachute or not in your backpack. But ultimately, the majority of times there is a parachute there, and kind of things end up working out.
So I have one last question about this Peixe Urbano story and advice to founders and operators right now, which is when you are in Latin America, the sales cycle of a company is lengthier than in the US. I mean, it takes you longer from starting a conversation or a potential acquire and closing the transaction than the US. And of course, there is a paramount decision because as a founder, you have an optimistic mindset and you always think that things will come back and they will improve, and you never really want to push the exit button. At what point did you start a Baidu conversation? How was that, and how did that play out over time?
Yeah, so we turned around the company, got it to profitability, ran it for about another year with kind of some modest growth. It wasn't kind of rocket ship, but growing. And then we decided we wanted to go out and sort of raise another round of capital. Right, we saw this big shift into mobile that was happening at the time. Just to give you a sense, back then in 2014, it was like 98% of e-commerce was happening on desktop, not on mobile. But we saw the curve going, and we had seen it happen in the US, we had seen it happen in China. We knew that in a year, that 2% was going to become 10%, and the 10% was going to become 20%. And we knew that for local services in particular, mobile was key, and we wanted to bring more money to make this shift, bring more money to the company to invest in the shift into mobile. So we went out to raise money. Give you some sense. In 2014 was the year of, sort of the first couple of years of the worst recession in Brazilian history. So economically, Brazil was in a terrible, terrible moment. The president Dilma was getting impeached, right? So political turmoil as well, and obviously this model of daily deals had been badly burned, right? So trying to raise around in Brazil at that moment for this model was just basically impossible. We were able to get some commitments, but really not enough that we felt we could make the shift into mobile in the way that we wanted to. So what we decided to do was, look, why don't we actually try to raise money from a strategic, someone that actually can extract more value out of the combined entity. They can put more money. We can do some kind of partnership. So we started speaking to a bunch of sort of strategic investors that could invest in the company. And what ended up happening was a few of these conversations, people were like, well, I like the idea of investing. I kind of see the value, but kind of what I really want to do is I want to have a path to control, or I want to eventually own this company, because if I'm going to create all this value together with you, I want to own it, right? And we ultimately decided as a board that, look, the best thing for now is probably to sell the company, given that we're having some interest, given that a clean fundraise is very difficult, if not impossible. And then we went down that kind of M&A path, right? So it was kind of an organic evolution of the conversations that came that way. And we ended up getting two term sheets, one from sort of one of the biggest e-commerce players in Brazil at the time, and one from Groupon, so sort of an international player that kind of was still investing in the model. And for a variety of reasons, we weren't entirely happy with the kind of the direction that those conversations were going. Like we fundamentally believed in the long term potential of the company, and wanted to invest in that, and weren't necessarily seeing eye to eye with some of these folks. So at some point I got introduced to someone from Baidu, because Baidu, for context for the listeners, is sort of the Google of China, right? They have, I don't know, 90% of market share in search in China, a massive publicly listed company, and I think in the NASDAQ or Hong Kong Stock Exchange, I forget. Was at the time something like 60 or $70 billion market cap company in China. And Baidu was investing into a shift into local services in China. They had made $1 billion investment into Uber. They had invested in a big food delivery company in China, and they wanted to come into Latin America, right? And even though we had shrunk Peixe Urbano a lot, we still had about 1 million people every month buying from us. And Baidu saw, look, this is a very strategic way for us to get into Latin America the way that we want to, and for us to get into local services there. So that conversation happened pretty quick. We met them. It was it fit like a glove, the acquisition strategically for them. And we told them, look, we are actually already having these sort of diligence process that's undergoing with these two other acquirers that it was already going on for like I don't know 2 months or something. It was a very slow process. So I don't know if we're going to be able to advance with this. And interestingly, they said, look, we can get this done in a month, right? Which for anyone that's done kind of big M&A internationally knows is like record time. And they did it, right? They kind of sprinted to the finish line in about a month from early conversations to I think money in the bank. And it was just 24 hours. And at the end, I went to talk to the sort of the Baidu M&A team that did the transaction. I was like, well, how did you guys move so fast? And they're like, well, we had two teams, one that was the day team and one that was the night team. And it just worked moving stuff forward, and I think left everyone else in the dust in terms of the acquisition. And the interesting thing about them was that they had a vision that aligned with ours, right? They saw that there was a shift in mobile, and they wanted Peixe Urbano to continue and wanted to invest more money in the company to allow for that shift. So we also felt like there was a cultural and alignment in long-term vision with them, and we felt like they were really the best acquirers for the company going forward. Not to mention that also it was sort of financially the best deal for all the investors and everyone involved.
Fantastic. And then you made something that only an entrepreneur would understand. After going through this hyper growth thing, then the big turnaround and all the personal impacts that would have, you went to start another company again.
Yeah. So, summarizing a little bit, I stayed about 6 months after the acquisition at Peixe Urbano. I had told my co-founder Alex, look, I'm completely burnt out from this experience. As you can imagine, the roller coaster ride that were those 5 years of, the hyper growth phase is exhausting. The turnaround phase is exhausting. The later fundraise and sale also exhausting. And I was like, I'm done with this. And I felt like the company needed a CEO that was willing to kind of stick through it for at least 5 to 10 more years, which is what this transition would require. And I wasn't the right person to do that. Um, and and I left, right. So 6 months later, I left. I continued to support Alex, sort of as an informal advisor and helping him out in the transition. He became the CEO of the company, and then I actually, before I started another company, I took about 6 months off, right. So I just like basically rested, caught up on my sleep and everything. And the process of starting another company was also a little bit of a winding road, because I had taken the time off and then I stopped and I was thinking like, what do I want to do next? I was seriously considering going into investing, like becoming a full-time investor. I had been doing it, as you mentioned in the very beginning. I had started a fund with four other friends of mine from a combination of Facebook and Stanford. We had started a fund called Graph Ventures that we invested our own money. In addition to, actually, as I mentioned, Chamath before, Chamath had actually built this fund called Social Capital. So for every dollar we would invest, he would also kind of mirror our investment one to one. And we had been investing that for, at that point, about 5 or 6 years. And I was seriously thinking about going into investing and decided, look, I probably have too big of a chip on my shoulder. I kind of want to give it another shot, right? The Peixe Urbano story, didn't end the way that I wanted it to when I started. It wasn't what I would consider a success case, and I wanted to try it again. So I ended up taking up the folks at Benchmark Capital that had been my first, they had led our Series A at Peixe Urbano. They had said, look, this was an up and down, didn't end the way that we all wanted it to, but we want to do business with you again. Why don't you come spend some time with us? And they hired me as a entrepreneur in residence, basically there to spend some time with them, considering maybe joining a portfolio company, maybe starting something new, maybe joining them in an investment capacity. Let's just kind of do something together. And sort of through that experience that I had moved back to San Francisco in 2000 and beginning of 2016, about 6 months into it, I decided to start another company. And the story there was that one of the partners at Benchmark at the time, this guy, Scott Belsky, who had started Behance and had just joined Benchmark, today, I think runs product and a lot of the business at Adobe. He had just kind of started kind of incubating or playing around with an idea, exploring the future of work in the United States. And he had been working with, Garrett Camp at Expa. Garrett Camp, for those that don't know, was the founder of Uber, was a co-founder of Uber. Benchmark still had a close relationship with him at the time. and a few other co-founders, and they were kind of toying around with this idea of the future of work and wanted to start this company. They had gotten off the ground. There were, I don't know, 3 or 4 people working on it, and they wanted a CEO to be sort of the founding CEO of this company. And I sort of fell in love with this idea. There's a company that eventually was called Prefer, and then joined full time. I don't know, about the middle of 2016 or so, as sort of the CEO of that company, which I went on to run for the next 3.5 years or so.
And Prefer began like it was a very hot startups, right? You had like a rockstar team, rockstar investors, of course, second timer founder.
Yeah, I mean, I think it was hot from the standpoint of like we had a good team, right? So, you know, Scott was the co-founder and was chairman of the board. Led the first investment out of Benchmark into the company. On the other side, so the other board member and sort of close advisor and investor in the company was Garrett, right? So from Uber fame. One of the other co-founders was a Brazilian guy, Vitor Lourenço, who's a good friend of mine. Was the first designer at Twitter, one of the first 10 employees. Amazing designer, probably one of the best ever when you think about product design. Was one of the other co-founders. We had another gentleman, Andrew Barr, who had also sort of been sort of a rising star in the venture scene and was starting a company. I mean, the engineering team was also great people out of great companies. So I think a lot of people saw, okay, there's a lot of talent here. They're all attacking kind of a really big ambitious goal, which was we wanted to become almost like the future platform for the future of work, right? We felt like as work became more and more independent over time in the United States, these new independent workers, they needed to have a platform that would be kind of the firm of the 21st century, and we sought out to build that. So it was really an ambitious idea to build basically the biggest company in the world. We felt this could be. So I think it was hot in that standpoint, that it was a good team with good investors, going after a really big goal, and sort of we were off to the races. I think with that context.
So before going up to the Atlantico and venture capital side of the talk, Prefer didn't get to product market fit, right? That's what I understand.
Yeah, so we basically, over the period of 3.5 years of running Prefer, we tried a bunch of things. We probably launched 6 or 7 different incarnations of what we thought could be a possible solution, and many kind of small iterations within that. I think we were very scrappy, moving very fast. The team was always small. It was me and mostly some product engineering folks, and a couple of ops folks, but really like 10 people at our peak. And tried a lot of things, but never got to product market fit. I mean, we got to a few things that were growing. I don't know, maybe at peak we're probably doing like $100,000 of sales. But I think that the fact that I had gone through these experiences of like real product market fit with Facebook and then with Peixe Urbano, Scott had seen the same thing at Behance, Garrett had seen the same thing at Uber. We sort of knew, like, once you've encountered true product market fit, you kind of really know what that looks like and that feels like. And we knew that we didn't have it, at least not at the level that we wanted to have it at Prefer. So we would do these trials, try things out for a couple months, shut it down, kind of restart. And after 3 years or so of hitting your head against a wall and trying different things to solve this big problem, and ultimately not finding the solution, we ran out of steam and said, look, it's we weren't able to solve this, didn't work out. We tried our best, tried everything we had, and tried all the ideas we had, and ultimately decided to shut down the company at that point.
Yeah, that's exactly what I wanted to ask, because they say product market fit is like porn in the sense that you cannot formally conceptualize that, but we know what it is when you see it. And you, of course, had seen it. I mean, in Facebook and Peixe Urbano, amazing product market fit, very fast companies. The demand was just skyrocketing. And how was that at Prefer? I mean, at what time did you see that product market fit was not getting there, and it was better to push the button?
I think it's like when you have to push the product onto people rather than trying to hold it back from when they're pulling it from you. That's the difference, right? And you feel it, right? You're trying to get people to use it, and they say, "Oh, this is a good idea," whatever. And they don't use it. Oh, tomorrow I'll look at it, or tomorrow I'll do this, or they'll check it out and they won't come back. Like it's pretty clear, um, that you don't have it. And I think I encounter a lot of entrepreneurs that say, "Oh, we have product market fit, etc." But I think it's easy to trick yourself into thinking something is working when you're kind of really pushing it out onto consumers and paying them to use it in some way, rather than people lining outside your door to use your product. And we definitely didn't have that. I think for consumer apps, which is what we had, you really want to see organic exponential growth. I think that's how I would define product market fit for organic consumer apps. And anything short of that is not product market fit, or at least not the level of product market fit that we like to see.
So, given that you didn't find product market fit and it wasn't quote unquote a success, Julia, does that mean you still have that chip on your shoulder and you still have one more in the backpack at some point?
No, I think I'm definitely like, I think that midway through Prefer, I remember kind of just thinking to myself like, oh, what did I get myself into? Like I had already kind of like said I'm never going to start a company again in sort of the peak of Peixe Urbano and sort of how challenging that was. And I think I made the mistake. It's like having a kid, right? You forget like the first few months of how hard it is, and you go have another kid. You're like, oh man, what did I do here? And the second time at it, I was like, okay, I'm definitely not going to do this. And I felt like at least I had that out of my system. It's like, okay, I tried again. I tried in a different way in a different market, right? Prefer was focused in on the US, and I was like, I'm ready to step off the field and still be a part of the game, but I want to be a part of the game as a coach rather than a player on the field. And I felt like venture was a very logical next step to still be very close to entrepreneurs. I think have that interaction with creativity and problem solving, but in a way that you're not on the driver's seat, right? You're kind of in the back seat and you're along for someone else's ride, which is very, very different.
But why in Brazil? I mean, you had been through Benchmark, entrepreneur in residence, of course, in the heart of US VC ecosystem. You had founded a company that was very hyped. You were present there for a big part of your life. And then you come back to Brazil and start Canary and start Atlantico. Why coming back here to be part of that new phase of your life?
It was almost the same reason that I came back the first time, right? It's I saw when I looked at Brazil in 2016. Oh, sorry, 20. When I came back was 2019. It was similar to when I went back 10 years before, right? 10 years before, I looked at tech and there was no new startups, no new people doing something. I had this great experience and I felt, look, I can come back and I can sort of lead the way and really have this unfair competitive advantage in building a startup. And when I looked at the venture capital in Brazil in 2019 or so, I felt, look, it's really emerging, right? You probably had what, 4 funds, 5 funds that had any real sort of scale. Compare that to probably 4,000 funds in the U.S., if not 40,000 funds. And I felt like the strategy of being kind of the big fish in a small pond was the winning strategy for me, right? I had a big edge, a big competitive edge in Brazil and Latin America. Whereas in the US, sure, I was qualified, but I was kind of one of hundreds, if not thousands of people that were similar. And I felt like really trying to go back to Brazil and try to be number one rather than be good or good enough was what I wanted to do. And that's why I decided to, dive headfirst into sort of building, I think, Atlantico and sort of the venture fund that I felt the market needed.
And the difference between Canary and Atlantico is exactly product market fit, right? That's your take.
Yeah, that's a good way to put it, right? So to give you some context, I had started at lunch Canary in so we started in sort of end of 2016. I had already at that point been investing for about 5 years and probably was one of the most active angel investors in Brazil. And I got together with a couple of friends, two entrepreneurs who at the time were running a company called Printy. This is Mate and Florian. Today they're running Loft. And then we got together with two other folks that were coming out of the financial markets, Marcos and Patrick, that were coming out of a public equities fund and that wanted to build a venture capital fund. And we said, look, no one's doing seed investing in Brazil. There was no, professional seed dedicated fund back in 2016. We said, why don't we build the first one? We'll leverage, the deal flow that I had and I think that we collectively had. And we'll kind of double down on this strategy and scale it up. So we started Canary back then. Canary was always focused and still is focused on being the first check into a company. So that's translating into kind of venture speak. That's usually kind of pre-seed or seed rounds typically, which often more often than not are pre-product market fit. A lot of times it's pre-product, right? A lot of times it's two people with a PowerPoint deck, and sort of in a dream. And I felt like the model of venture capital that I wanted to kind of pursue with my career was one where there was a little bit less market risk, right? You already had some data that you could work off of to show that this value proposition or this product had traction in the market and was starting to scale. And then now I could come in as an investor and have sort of fewer, closer relationships with entrepreneurs and help them in the scaling phase, which I felt was once someone has that early product market fit, that's when I want to come in and invest. And that, I think, in Latin America is typically a Series A is probably the label of that round. I think we're not usually that attached to what the label of the round is. Like sometimes we've come in a little bit before the Series A. We've also come in sometimes after the Series A, maybe like at a Series B. But when you look at historically what we've done, 75% has been a straight down the fairway Series A round that company has hit product market fit and is ready to step on the gas pedal as far as accelerating and scaling.
So is that kind of like the benchmark model in a way, like
Yeah,
specializing in
I
Series
think
A?
I think that the benchmark model and really what we did was we did a copy paste of I think the benchmark playbook because we felt like that was missing in Brazil and Latin America when we started. We felt most of the funds here were going into much more of that, call it the Andreessen model of kind of a lot of money under management, big platform, multi-stage, right from seed through growth. And we felt like there's a lot of benefit to focus and specialization. And I think Benchmark has always had that discipline of being very, very focused, of I think having the discipline to maintain a small fund size so that they can have, really, really high multiples of return, which are obviously impossible to do with more and more assets under management, obviously mathematically harder at least. And we felt like that was missing. And I think the benchmark model is very much look, we want to find a company that we have a lot of conviction. Usually it's post product market fit, but not always. But it's like we want to partner with you early and we want to partner with you sort of throughout your journey. But they usually come in with a check at the early stage and usually don't do kind of growth investments or don't do kind of idea investments, although there's obviously many exceptions to both of those.
And is it also, Julia, the benchmark model in the way of small team, equal partnership, and stuff like that, or not to that extreme?
Yeah, so we've always tried to be very small, like a small team, kind of very lean and focused. We always felt like kind of constraining the team size actually leads to better decisions, right, and better prioritization. So
How
we've
big is
definitely
the team?
there's four of us on the investment team. There's two full-time partners, myself and my partner Anna, and then we have an associate and a data analyst that kind of help us out. But always try to keep it around that level.
Okay, so fairly
You
small.
just opened two positions, right?
What's that?
You've just opened two positions.
Yeah, so the way we've thought about the associate position is that it's not an eternal position, so it's not a partner track position. So the idea is people come, they stay with us for 2 years, 3 years, and the idea is then to bring a second one. So we think about we're now hiring a second associate that we just posted a job opening for, and the idea is that kind of one comes in, the next one eventually moves out, and we kind of keep that flow of people kind of early in their career as venture investors.
Yeah, USV does that very well as well. They
Yeah,
tend to
we
do that.
we copied the USV model.
And when did the report idea came out? Jaime told me the other day that he was like, I'm reading the Atlantico report for the interview, and holy crap, this is awesome.
Yeah, so the report actually came about in our very first year. So we actually we've always had a very close relationship with the team at Bond Capital. That's the growth fund in the U.S. Started by Mary Meeker. And Mary Meeker famously published for almost 20 years the Internet Trends Report, which was sort of the canonical, I mean, more than 20 years actually, like the canonical publication every year in the tech space. And we had spoken to the Bond team about collaborating and doing kind of a Latin America chapter, and we were thinking sort of there really should be something there. And that year, 2020, is when the pandemic hit, and it was actually the year that Mary stopped publishing Internet Trends, which is sort of what we wanted to be part of, right? We wanted to publish that Latin America chapter in the same way that Hill House did the China chapter. We said, look, they don't have it anymore. Let's just do our own, right? Let's just do our own, Latin American version of internet trends. And again, we basically sort of copied the format or sort of the messaging. I think both, Mary Meeker's Internet Trends. I think also Benedict Evans publishes an annual presentation that was also a big inspiration. We said, look, we really need to have kind of an annual report that becomes sort of the go-to document for technology in Latin America. And the reason why that's important is threefold. First of all, we've always been very, I would say, research oriented as investors. Like, we like to, understand a space and go really deep in it and have a sense of how the pieces fit together, so that when an entrepreneur knocks on our door and says, "Hey, I have a vision for what the future of healthcare is going to be or fintech is going to be," we already have a mental model for how that works. So we've always done a lot of independent research to come up with frameworks and a frame of mind to analyze different markets. So this was an opportunity to organize a lot of that research that we were doing, and then sort of tell that story. And I feel like telling the story based on data and research actually gives you a lot of clarity in your thinking of how you organize the puzzle pieces. So we wanted to do this. Number two, we felt like it was a great way to build our own reputation, right? We wanted to build a reputation as a fund, not only as a fund that's kind of has that entrepreneurial DNA, that it's sort of founded and run by people that were former entrepreneurs and CEOs, but also that was very thoughtful about different models and was very research and quantitatively driven. And we felt like putting our work out there for entrepreneurs to see was going to help further our reputation as someone that could be a partner in that sense to an entrepreneur. And then finally, we just felt like shining a light on everything that was happening in tech in Latin America was going to be very beneficial to the region globally, right? And very much with a view of, a rising tide lifts all boats. And that's why we also kind of, write this very much thinking about an international audience, an international investor audience or international investor audience that wants to think, what's happening in Latin America? Why should I be excited? And we want to be able to tell that story to the world because we think it helps the region be successful in the long term. And as a region is successful, obviously we as a big player in the region can be successful alongside it.
Yeah, I mean, I told you, Julio, before we started recording, as someone who has done these kind of reports before, and just for Spain, and you guys do it for LATAM, I think it's amazing what you guys put out, because I kind of know the work that goes behind the scenes to put this out. And I was actually also telling Goose that I probably need like 2, 3, or 4 rereads to actually understand all of the information and all of the context that you guys have in there, because it's super good. We'll actually add it in the show notes. So last question from my side before we jump into the last two, and I think Goose also has one. uh, what's been the biggest surprise about scaling or building and scaling a venture firm? Because there's probably similarities compared to the entrepreneurial side, but there's probably also like some key differences that you were not expecting. So what have been the biggest surprises, Julia?
I think the hardest thing about building a venture fund is the learning process, right? So you invest today and you make a decision on investing, but you really only find out, I don't know, 5 years, sometimes more, whether you made a good decision or not. So learning from your mistakes and learning from your successes has a very long feedback cycle. And I think that makes it very hard from an iteration and learning standpoint. So, at the fund, we very, very actively discuss kind of quality of decision making internally. Every 2 weeks, we do like a big debrief session on all the companies we decided to invest in, and as well as the ones we decided not to invest in. And we do a lot of, I think, almost kind of decision support to think about what could have gone right, what could have gone wrong, what are our biases, what were the drivers, and we record all of that and document it for the future. So we think that sort of that process of thinking about the quality of decision making is really important to grow. I think I also have, I think, a lot of great mentors that have been in the business for decades and have seen a lot of ups and downs. So part of it is, how can we learn from someone that's done it and try to take some of those learnings and bring it in house? You mentioned sort of Benchmark Capital, and Andy Ratcliffe, who's one of the founders of Benchmark Capital, not only is a sort of a big investor in our fund, but also sort of has been a mentor of mine for over 10 years. And, people like him, and there's probably about a dozen or so of them that have that level of experience, just talking to them on a regular basis and trying to take their wisdom and somehow apply it to our decision making is the way that we try doing it. But that long feedback cycle is definitely by far the hardest thing.
And I have one last question. You've obviously done some research, a lot of research on the US VC ecosystem to found Canary and then Atlantico. Both of these companies, they are very, very disruptive in the Brazilian VC ecosystem scene. Um, what do you think it's missing now?
I think what's missing is time, right? I think any ecosystem is based on people and human capital, and I think today we finally have enough depth of talent and technology to really be able to scale big companies like the Nubanks and the iFoods of the world. The And I think that now, as we think going forward, is we now have a little bit more breadth of talent, so more people, right? So I think we have enough talent, and there's deep talent, but not a lot of people still, because we just haven't had that much time to develop people and for people to grow, and really for ecosystems to mature and flourish. You just need more time, right? You need to give time to time for people to develop and grow, so they can go and learn, start new companies, develop new talent, and I think that's a multi-decade process.
Awesome. Julio, well, we know you're on a tight schedule, so I think I want to thank you for your time, and we really appreciate this conversation because I think it was a very insightful and interesting one. So thanks a lot for making the time, and thank you for putting it together, Goose.
No, thank
Thank
you.
you
Thank
very
you for
much,
having
Julia,
me.
for coming.
It was a pleasure chatting with you guys. I had a lot of fun.
Thank you.